Okay, so just to go through high level how we are going to attempt it today. So we have two standards to cover, IAS 1 and IAS 8. Of course, we have 43 slides to go through, but not to worry. A lot of them have the numerical or objective questions. So that will be flying through and something that we can look forward to as well. So IAS 1 and 8, both the questions will be covered at the end. We also have, as promised, the memory map for each of the standard. So at the end of IAS 1 and 8, both, you will have a memory map, and the objective of that is to revise that as frequently as possible so that we remember the key points about each standard. Okay, this is colorful and it is very helpful to retain the key points and memorize the stuff. Okay, so starting with IAS 1. Essentially, IAS 1 is about the presentation of the financial statement. So there are primarily 4 or 5 statements that IAS 1 deals with. 4 or 5 because there are 4 primary statements. It's called Statement of Financial Position, traditionally known as balance sheet. Then Statement of Profit and Loss and Other Comprehensive Income, also known as traditionally P&L. Statement of Changes in Equity, and finally the Statement of Cash Flow. We know the cash is king, so without that no set of financial statement will be complete. And finally the notes, because note will clarify and further explain any number which has been mentioned in the core or core financial statements. Moving on to the fundamental principle, which is again the framework for the preparation of the financial statement, that talks about going concern, consistency in presentation, classification, and the accrual basis of accounting. These are like a key terms, and we will go through in further details in the henceforth slides. IAS 1 requires the entities to present single statement for profit and loss and other comprehensive income. It also gives the flexibility to produce the profit and loss separately, but then statement of comprehensive income needs to be just at the bottom of this. So essentially, profit and loss needs to also be supplemented by the comprehensive income statement. Hence, this is called profit and loss and other comprehensive income. The next one is, the next point actually, and the requirement is that income tax is a key component to be separately classified. So either we can put that in the income statement or a statement of profit and loss or in the disclosure notes. Why it is important? Because income tax has a higher credit requirement. Like in case of liquidation or bankruptcy, who are the ones who should have higher claim on the cash of the organization or the company? Income tax before anyone else, right? So it is an important number to highlight in P&L or in the notes. So there are also a requirement for the grouping in the P&L, because in P&L you can group similar item. However, anything which is material and different in nature or in function should be classified separately. That should not be grouped. For example, cost of goods sold, or sales and marketing, or administration. These are basically by nature separate items, and they should never be clubbed together, even if they are small. However, if you find out something which is material, generally it is also a matter of judgment. However, if you think any expense is higher than 10% of the entire expense of the profit and loss, you need to highlight that separately. You need to have a separate line item for that, as per the rules of IFRS. Also, there should be a comparative number provided. So there are two ways that we provide the comparative number for the financial statement. One is in the 4 primary statement or the balance sheet, P&L, etc. We provide comparative number line by line, side by side on the 4 primary statement. Also, when we provide the notes and we say that, okay, the consultancy fee or any particular professional fee was 10 million for the year 2020, we also need to provide in the bracket that it was 8 million in the preceding year or 2019. So comparative will not only go in the 4 primary statement, but also in the disclosure notes. Of course, we have various other rules also which dictate that, and we'll talk about that in the next few slides. The first statement is saying it's just a matter of accuracy. That statement of changes in equity must be of the same status as the other 3 statements. In simple language, all your 4 primary statements must be talking to each other. We cannot have total net asset X million as per the statement of changes in equity and Y million as per the balance sheet. It's a very basic fundamental thing that should be always taken care of. However, sometimes we might miss this while making the calculations, and that's why generally and typically organizations have varieties of different checklists, checkpoints, review process, etc. to have the controls on those quality aspects. Even the difference of $1 or 1 rupee is not permitted. We need to provide total comprehensive income for the period. In the statement of changes in equity, there should be opening capital of each type. So if there are different type of equity, like say share capital, preference capital, etc., preference shares, so there should be a reconciliation for each type of equity separately in the line, in the column. So for the preference share, for the common equity, it should be like opening, changes, and the closing number. That should be reconciled. In addition to this, we need to have total comprehensive income for the period. When we say for the period, it could be the entire year, or it could be less than or more than a year as well. When we say, when it is not exactly 1 year, 12 calendar month, it is called period. If it is say 11 months, 10 months, or if it is say 13 or 15 months, that should also be provided. Plus, there should be a line item to highlight a couple of other things, which is changes in the accounting policy and its impacts. So if there was any change in the accounting policy for the year or accounting estimate for the year, which has given rise to changes in the P&L or equity, that should also be highlighted, because that's an important item for the statement of changes in equity. Or there was any sale of a major entity of the organization, which resulted into gain or loss, that should also be highlighted separately in the statement of changes in equity. Additionally, the final point is, and a rule of thumb which is applicable across all the 4 or 5 primary statements and notes, is that IAS 1 requires that financial statement should present the true and fair view of the financial position. It should also follow any other financial standard which is related to the financial statement. The only case when preparer of the financial statement can depart from the given financial standard is when that departure or that deviation gives a better view of the financial position. Okay, in a simple way, if you decide to not follow certain rule of say IAS 1, 8, 12, 14, any account IFRS standard, that is permitted in only one case, when you think not following the rule can give a better picture of the financial statement. That's where the flexibility is given. That's always remember that IFRS goes by the reality and substance of transactions. It is not requiring just to follow the rules. So in that spirit of the true and fair view and substance over form, IAS permits the departure only when the departure gives a better view of the financial situation of the company. Next, all the information should be following the 4 criteria. Relevance, I think we have covered this briefly, but it's good to always remind ourselves: relevant, reliable, comparable, and understandable. Comparable is in a way required by the standard itself, IAS 1, because last year's numbers needs to be provided for the comparison, and also in the notes, right? So comparable. Understandable, of course, understandable it should be. There should not be jargons or acronyms or too many numbers clubbed together so that people cannot really understand what is going on in the P&L or in the balance sheet. So it should be understandable. Relevant. If we provide too many granularity of the details, which is not relevant for any investor. So suppose we are talking about the balance sheet of $200 billion, and the information is provided for few $100, and every line item is broken for even a couple of $1,000, which is not material, then it is not a relevant information. The information should be relevant so that the investors can focus on the right information. And finally, last but not the last, the reliability. It has to be reliable. That's a matter of the quality, the integrity, the ethics of the reporting as well. So it has to be reliable number. Now, there are other principles that needs to be applicable, such as going concern, accrual, consistency, and materiality. We'll talk about all those items separately. So this one is talking about largely the same point that we have talked about for statement of changes in equity. Next, so this is the page I was referring to. We'll talk about all the key concepts of the presentation for financial statement. And remember, this is not the end of the rules for IAS 1. There are various other subsections and granularity and various clauses, but we will definitely cover the key points in the slides. Materiality. How do we check the materiality? I know the concept wise, it should be any information which is material to the user of the financial statement, right? And as I said earlier, any information which can change your mind, which can swing your decision from investing to not investing or vice versa, that is considered to be material information. Now the question is that how do we assess materiality? What is a benchmark for that? 2 key aspects of materiality. Anyone, you want to volunteer and help me fill the gap? Okay, so materiality is of 2 types, qualitative and quantitative. So whenever somebody approach you and say that, okay, do you really think it is a material information? Should we disclose this in the primary statement? We can think 2 ways. Quantitatively, like numerically, right? So let's take the example of a balance sheet which has $200 billion worth of total capital. Now, there was a loss of, or maybe there was a theft of $20,000 from the cash account, or maybe the petty cash in one of the office of the company. So there was a theft of $20,000. Company's net assets is $200 billion. Do you think quantitatively it is a big number? It is not. No. Numerically, it is not a big number. 20,000 for a balance sheet of $200 billion, not a big number. However, now let's talk about the qualitative aspect. Qualitatively means look at the nature, look at the varieties of other aspect of this number. What could have gone wrong? So in that aspect, it is an important number to disclose because that shows there is a breach. It shows that there is a loss of control. There is a loss of physical security, or maybe the electronic security, or there is a kind of lack of integrity somewhere. In that aspect, it is a red flag, which can one day result into the theft or loss of a bigger dollar amount. Hence, it is material information. On the other hand, imagine there is a one day penal loss because of one of the derivative security to the tune of $1.5 million. Now, numerically, it is substantial information that should be disclosed separately, and there should be a small discussion in the notes as well. Why it happened, and what caused this loss, and what will be the checks and controls to prevent this in the future. So that is the materiality. Going concern is an assumption that the organization and the entity will continue to do the business the way it is doing now, and auditors and the management have full confidence that there is no sign of discontinuity. The business can continue as it is right now. There could be some if and buts. There could be some exception to going concern. And again, the materiality comes into the picture there. Imagine GE, taking the example of GE again. It has operation all over the world. One of the major operation, imagine, again, taking the example of maybe China, there's a massive manufacturing plant. If auditors find out that generally GE is a good going concern company, there is no any matter of concern. However, one of the plant which had been invested with $200 billion, or maybe some $100 billion at least, that is likely to close because of some major technological failure or any loss of local market. That could cause a going like a breakup basis of the financial statement. So that could cause question the going concern basis, because auditors should be now very and concerned about the status of going concern. So going concern is when everything is going good. The word is a little catchy. It says going concern. In fact, when things are at going concern, there is no concern of going, right? You need to remember that way. It's just the opposite. When you have no concern that it will continue to grow, then it is a going concern. When you are concerned, then it is not a going concern. It is a breakup basis. Breakup basis means the company can stop the business. It may not survive long enough, or this year itself. It may file bankruptcy soon if it is a breakup basis. Okay. So going concern again is a matter of subjective judgment. Auditors needs to assess whether any massive loss or the plant malfunctioning or any such issue or challenges in the particular market, if it is going to impact material revenue or asset of the company, auditors needs to consider whether it is going concern or a breakup basis. Next, accrual basis of accounting. It's just saying that companies needs to accrue the cash, the expenses and income before it hits the cash account, right? So the accrual basis. Presentation consistency. Again, it talks about being consistent. So if you apply one rule last year, you need to apply the same rule this year. Any rule that is applied for one of the primary statement, like balance sheets, similar rule, same rule should be applicable for other primary statements as well. So within the same year and across the different year on year basis, you need to be consistent in applying the concept. Also, if you think similar business in the same country is impacted because of certain legislation, you need to consider whether other businesses can also be impacted. That is a consistency check. Next one is materiality and aggregation. Again, it is really the aggregation, because if you find that there are various small items which are of similar nature or the function, they need to be clubbed together. For example, imagine there are various small admin costs for the same company. Take an example of $200 million. And there are various admin costs like maybe electricity, rental, staff maintenance, etc., which is like less than $1 million, right? And they're all small ones. Then you may consider to club them together when it becomes maybe $4, $5, or $10 million. You don't need to provide a breakdown of all such number. One head admin expenses will be sufficient, because there you need to consider the materiality again and the basis of aggregation. So if something is immaterial and has the same nature or same function, you can club them together. Offsetting. Offsetting of asset liabilities are basically not permitted. The reason is the following. Imagine there's a company A, and company A has a creditor, which is company B. And company B is going bankrupt. So in that case, company B cannot pay anything to company A, but can company A also choose not to pay to company B? And this was a similar situation during the Lehman Brothers crisis. So imagine that Lehman Brothers owed money to Citibank, and Lehman Brothers is crashing. Citibank also, during the business transactions, Citibank also owed money to Lehman Brothers, right? So can you really net off the two transactions before the bankruptcy is filed, before you know that there is any problem? Generally, if you have a asset and liability, if you have a debit and credit both with the same party, you should not net it off. Because in case the other party goes bankrupt, you cannot deny the payment to that party. So Lehman Brothers may choose after filing bankruptcy not to pay to Citibank, but Citibank cannot choose not to pay to Lehman Brothers, even if Lehman Brothers did not pay to Citibank. That means even if you net off dollar amounts or rupee amount, it is not going to help, because ultimately whatever you owe, it has to be paid anyway. So we cannot say that, okay, the net of basis is like, $2 million only, because the other company owes to me 8 million. I owe 10 million. So let's net off. No, it is not permitted. And then comparative information, we have already discussed that at least 1 year of information needs to be provided for comparison.
So Nitish, what is the difference between the first point and the fifth point, materiality and aggregation?
All right. So the first point is all about a general materiality. So here we are saying that if any information is important, that needs to be disclosed. So for example, let's take the example of the fraud I discussed about. So there was a fraud of $20,000. Generally, you don't have to have a line item for that, nor do we mention that in the disclosure notes. It does not require generally any mention, but since it is a fraud, we need to have one mention that there was an issue in reconciling $20,000 and it could not be found, right? Why? Because it is a material information, not in terms of quantity, but in terms of the quality of the checks and controls, right? That's one example. Second example could be that there was a loss of 1.5 million for a particular product in the market. Of course, we don't mention that on the face of the primary statement, but in the disclosure note, we need to mention that this particular security faced a loss of $1.5 million. And in the future, we are going to put a control about this, right? So we need to highlight any important number which concerns the primary statement or the investor. So that's one concept. Secondly, materiality and aggregation. This point is trying to highlight that sometimes you need to aggregate the number. You need to club the number together. For example, admin cost. So if there are like 5 admin costs clubbing together up to 1 million, and you have the balance sheet of $200 billion, you really need to club all the small number together and show this. So it is saying that aggregation is allowed when all the small numbers are not material. So while doing the aggregation, you need to consider the materiality. So materiality is the test for aggregation, right? That is the 5th point. But when we are talking about the materiality in the first point, it is providing a general concept that materiality is such an important idea in the financial statement that if you find any information material, you need to separately disclose and talk about that.
So how we can decide the limit, like as you told that let's suppose the minimum amount, if we have a minimum amount for the admin charges,
right?
So on what basis, like is there any disclosure under the IFRS, like this up to this limit you can club it and show in the financial statement, or whether based on the management decision or based on the understanding we can club it and show in the presentation?
Second choice. So IFRS in any of the standard basically did not talk about the threshold for that clubbing on the basis of materiality. So it generally does not talk about this. It's just say that it is the subjective judgment of the management which will be applicable here. And that subjective judgment of management needs to be validated by the auditor as well. So it is generally it goes by the industry practice first of all. Because materiality, as we know, in the investment industry would be completely different. Because generally admin and all these costs could be very small, but even if one particular forward made a massive loss, it could be material. But the same expense for a large manufacturing company, like admin cost, could be a different number, right? So that materiality threshold for various line items are very specific to the industry that being audited or for which the FS is prepared. And it is subjective. It is up to the management also to decide. Of course, since auditors are going to go through that, any crazy judgment will not be accepted. The second rule is generally what is followed in almost all the industry is that 10% of any expense. So if any of the expense is 10% or higher of the entire expense of the P&L, then you need to show that separately. Even if it is kind of you think that it is irrelevant. Suppose that somehow the admin staff was paid a very high amount. Generally, those numbers are not very material, generally not highlighted. But if it is exceeding the 10% benchmark, then general industry practice is that you need to show it separately in the P&L. Does that answer your question?
Yeah, basically, practically, I have seen many times under the admin charges we have a multiple sub-component, right? Like the exact the same example, like the electricity charges. So what happened? They are overlooking that because this is the minimum amount for the related to the electricity charges.
Yeah.
But in the quarter, when management looking comparing the budget versus actuals, so they come to know like it is impacting the OPC costs, like other operating costs. So on that time they are realized that we should separately, we need to show this separately because that electricity charges impacting in the OPC cost, and that impacted to the until unless the net profit or net loss.
Right, indeed. And again, here when I say that materiality is a matter of judgment, there's another rule that is applicable here, that it is fluctuating, right? The electricity bill is fluctuating quite significantly. In that sense, it also becomes material from the qualitative sense, because if you don't have a very good way to estimate this, and if it can fluctuate, that is again something that needs to be shown separately, because materiality is not always about the amount of number or the quantity. It could be about the quality as well, or the nature, right? So qualitatively speaking, any fluctuation of the number also deserves a separate identification, because that number can vary significantly time to time, and it can kind of cause the variance in the P&L. I think you have observed the variance in the expense as well as the P&L, and that is coming from that electricity cost or any other such cost. So that means that needs to be highlighted and should have a separate line item as well, because materiality is about the qualitative and quantitative aspect both.
Yeah, fine.
Sure, connect from any device. Everything is okay as long as you can hear and go through, or else we can provide you the content, everything later on, but try your best. Thank you. Next one. Presentation of financial statement. How do we present? Notes containing a summary of significant accounting policies and other explanatory notes. So we have observed that there is a need for the notes. Why we provide the notes? In order to explain the further details which the balance sheet or the P&L cannot explain. Because generally balance sheet and P&Ls have separate line items, and line items have the number. But you might have various questions about those numbers, how it is being calculated, and what is the trend about those numbers. That needs to be discussed separately in the disclosure notes. I have provided a separate small box, identification of the financial statement. So the financial statement should have certain minimum amount of information as well, which is name of the reporting entity, the time period for which it is being prepared, the presentation currency, and how many decimal places of the rounding is being used. So these are some of the what you call the vanity aspects of any financial statement, because imagine that on one hand you have a primary statement of one company which is reporting for 1 year, another one is reporting for 1.5 years, or maybe only 8 months. You cannot really compare unless you know what is the reporting period. So it is important that we remember that normally we say as at for 1 year of the reporting period. But if it is not for 1 year, not one calendar year, then it is called the reporting for the period of, or period from maybe October 1, 2019 until December 31st, 2020. So whenever it is not a perfect calendar year, then it is a period reporting. An important point, though we will also revisit this in the accounting policy IAS 8, that whenever there is a change in the accounting policy, and what is the change in accounting policy? The accounting policy is considered to be changed when, say, you have amended the policy of, say, depreciation. There are two types of depreciation: straight average depreciation and reducing balance depreciation, right? So these are two different way of depreciating. If you change from straight method to the reducing balance method, or vice versa, it is change in accounting policy. Whenever it is done, all these impacts are analyzed retrospectively. That means you need to also consider what would have changed, or what will be the impact in the previous year's numbers. Because in IFRS, we report 2020 for this year and then 2019 as a comparative. So if we change the accounting policy, we need to also do retrospective analysis to find out how the number would have looked for 2019. And you know why? Because if this year you're, say, showing the depreciation to be $10 million, last year your method of depreciation was different and it was showing $12 million, right? For two different approach, we cannot provide the comparative numbers because the approaches are different. So the number will be different. So we need to amend the same number for 2019 as well, using maybe a reducing balance method only. So restate the financial statement of previous year whenever you change the accounting policy. That's called restatement. And this is one of the key criteria for restating the entire financial statement. Not only your one statement will change, it will change almost all of them. Balance sheet will change, statement of changes in equity will change, the P&L will change. Of course, the cash flow is the only one which will not change, except for some changes in between the line items can just move. But overall, your cash flow will not change, but all other three primary statements will change when you're changing the accounting policy. So you need to restate all the number. Even in the disclosure notes, you need to provide the complete explanation as to why the accounting policy was changed. We'll talk about that further in the IAS 8. Next one, presentation of financial statement. This is talking about the format of the balance sheet or statement of financial position under IFRS. So of course, we have assets and liability and the shareholder equity. One thing to remember, IFRS do not specifically prescribe what should be the format of the primary statements. It just provides the guidelines, what should be provided, right? So it is not saying that you need to only follow this presentation or this format. It should be classified this on this heading. No, it gives the prescription of what should go, what are the key line items, and how disclosure should be made, but it does not prescribe a format. So one of the popular one is here in front of you for two companies, Speedway Limited and Greencastle Corporation. Are you able to see, by the way, the screen? Is that visible enough and legible?
Yes.
Yeah.
Okay, excellent. So asset, current asset, cash, accounts receivable, total current assets. So typically, all the balance sheets should have current asset, current liability, and long-term asset and liabilities. Some rule of thumb that any asset or any cash which is realizable or convertible, any current asset which is convertible into cash within 90 days, that will go into cash and cash equivalent. Then there are some other line items. Generally, if something is held for trading within that calendar year for 12 months, it should be classified accordingly. Otherwise, it will go into the long-term asset or property, plant, and equipment. So the rule is saying here, expected to be realized in or intended for sale or consumption in the entity's normal operating cycle. So it is just saying that current assets should have certain criteria, like either your inventory, cash, account receivable, like somebody is due to pay, you have sold the goods and services on credit. So all those are part of current asset because they are likely to get converted within a year. But property, plant, and equipment should be a separate line item. Other assets should be a separate line items. Similarly, liability will have various line items as well. Generally, if you have a liability for the year, so within 1 year, you have to pay back to someone, that will go in under the current liability. Anything beyond 1 year will be in non-current liabilities. And of course, then we have shareholders equity, which is clubbed with the overall liability, because then it will match with the asset. In some places, like based in where we are reporting, Asia versus Europe or North America, it is observed that generally North American countries report on the basis of liquidity. So it will start with the most liquid asset from the top. Whereas various European countries, generally even under IFRS, they start with the fixed assets. It is just opposite. Generally the fixed asset which is not as liquid, which is most illiquid, that's how they will start. So there could be certain particularities of the various reporting zones as well. Because IFRS does not prescribe any hard and fast rule how you start, both are acceptable. We have talked about asset and liability. That should not be offset because you cannot deny somebody the payment just because the other party has not paid to you. Because the other party can file bankruptcy and they can get the legal protection. They can choose not to pay legally, but you may not choose not to pay just because the other party has not paid to you. So offsetting does not is not permitted, because offsetting just say that, okay, I owe X dollar to my vendor, and vendor also owes something to me, so let's net off the amount. That is not permitted. Statement of profit and loss and other comprehensive income. So here we have a very straightforward model. 2018, 17, both is here. Interesting item is that in P&L, we can show the expenses, again, as the materiality goes, that if something is 10% or more, we need to show it separately. And on the same time, within P&L, there are two rules. You can present the expenses either by nature or by function. If you choose to report by function in the profit and loss statement, then still you need to report by nature. Why by nature? Because that gives a real insight as to what the expenses are doing and how it can impact the future of the P&L as well. For example, what is the nature and what is the function? Let's talk a little bit about that. So generally, the nature is when we talk about work in progress, raw materials. So it is about the processing of the goods or the inventories. So supplies comes, then it is converted into, or maybe raw material comes, then it is converted into the raw work in progress, then inventory is ready and it goes into the stock room, it waits there. On the same time, there are some depreciation. So if you really look at the nature of the expenses, which is supply, work in progress amount, or how much is spent on, say, depreciation, this is called nature of the expenses. But when we talk about the function, it is easy to understand that we consider this as like a department. So cost of sales, marketing, admin, selling cost, marketing cost, admin cost, these are the functions. So there are two ways you can report the expenses, by nature or by function. If you choose to report by function, you can report in the P&L, but you still need to provide the details of the nature in the disclosure notes. This is important concept, both in the practical world, in our workspace from the examination perspective. So would like to understand, do you have any question on this?
No.
So Nitish, just one thing to clarify, it is always preferred to show the expenses by their nature. That's what you said, right?
Yes. You will have less effort if you show in nature, because then you don't have to provide further details in the disclosure notes. Because it's like saying that, okay, fine, you like to show by function, but I would still ask you by nature anyway. So why not to show by nature? That's the approach.
Okay. And that's why a majority of companies across industry, they choose to show by nature rather than function.
Right, because there's no escape ultimately, and that gives a real insight. Because not to forget, we faced a couple of times the call from the end investor. So when we prepare the financial statement signed by auditors, right, it goes to the investors, right? We often got a call from the investor's own accountant. They have the accountants as well, and they say, hey, you provide this number and you have provided in the disclosure note as well, but when I was comparing this disclosure with the last year and last 2 years, we saw something very interesting and curious. Can you please explain? And then we go on to the calls and long discussion, because there is a long list of the users, and always someone has the question on those expenses, because nature tells a lot about those expense and how it can go up in future as well. Other item is what we're seeing here is like a typical statement of profit and loss. Why typical? Because look at this green castle corporations line items, right? It is saying cost of goods sold, gross profit, operating expense, income from operations, blah blah blah, interest expense, but there's no extraordinary items. Extraordinary, what I mean is that there's no sale of maybe an office or any real estate of the company. There is no impact of the hedging, right? Unhedged amount. There's no any other fine or any legal penalty anywhere discussed here. There's no FX related loss or gain mentioned. There is no impact of the pension funds or defined benefit plan as per IAS 19, right? All those things are not relevant for this P&L income statement. So I think they have not mentioned. But if it was there, then we need to have other comprehensive income, a line item. And within that, all these number like defined benefit plan or impact of the hedging or FX fluctuation, those things will be mentioned. And then our statement of profit and loss and other comprehensive income will be complete. In this case, it was not needed, it's okay. But it's good to know that it exists. So see here in the little box, I have created a statement of comprehensive income. This is talking about that line items within other comprehensive income are required to be categorized into two categories. Those that could subsequently be reclassified to profit and loss, and those that cannot be. What it is really saying is that even if you report something in other comprehensive income, you still need to classify that if those items in future can go into the main P&L, if that can be reported under the profit and loss. And there are some situations. If you want, I can give one top class example, that if there is an asset that you have held it for long-term investment, right? If something is held for long-term investment, it is not reported under the statement of profit and loss under IFRS, because it is for long-term. If you report in the profit and loss, every time that long-term asset fluctuates, your P&L will go ups and down, roller coaster. However, you know that maybe 2-3 years down the line, you're going to sell your big property and make money. So there you will report that into other comprehensive income, but you can classify that it could go into the P&L, right? So that kind of categorization it is talking about. Statement of changes in equity. So as discussed earlier briefly, we have the starting capital for this. Changes during the year, again that will come from the P&L and comprehensive income, other comprehensive income. Any change in the capital, so if there is a new subscription or some investor left, that needs to be reported. So the opening capital or the asset, P&L or the other comprehensive income during the year, then any changes due to the capital transactions, like new capital coming in or any capital going out, those things will be mentioned there, and you have a final number. In case you have different types of capital, then you need to provide the reconciliation. So if common stock and the preference shares are there, then you need to talk about opening, changes during the year, and closing for each type of capital as well. So that's a flag to remember. Also, in this, we talk about other extraordinary items, such as I said earlier, any changes due to the accounting policy. Any impact on the number due to the accounting policy are also highlighted here. Right. So that's all really for statement of changes. Amount of dividends which is distributed, that also goes here. This is presentation of financial statement for cash flow. Cash flow is typically discussed under IAS 7, but we should just have a quick look for cash flow as well. These are of three types: operating, investing, and financing activities. Operating activities typically talk about all the cash flow, not the expense, not the receivable or payable, the cash flow because of the operations, which is day-to-day operation of the company. Next item is investing activities. If you are an IT company or manufacturing company and investing into a real estate, then it is not your operating activity. It is not your operating business. It is a pure investment, because you thought that, okay, you have extra money and you should get exposure to the skyrocketing real estate in your town. So you invested into some real estate and you made that your office. So that is the investing activities. And the other one, financing activity, when subscription redemptions and any dividends, etc., or new debt issue, debentures are summarized there. So anything which really impacts the capital of the company, right? The equity or preference shares, debt, fixed income, any servicing cost, like in interest or such charges paid on the fixed income, or any dividend paid on the common stock, those will go into financing activities, right? I do understand if you look into the details of this cash flow, you might feel that the operating activities have really nothing in this, because it could be just the nature of the transactions and the business. But generally, all three categories are important, and business to business and industry to industry, it can vary how it is reflected. Then there are two ways of preparing cash flow statement as well: direct method and indirect methods. We'll talk about that in IAS 7. This is about the disclosure notes. It's talking about the details that is provided here are matter of judgment, matter of, again, providing the true and fair view, and all the relevant information that should help the decision makers. It also contains how numbers are derived, what is the pattern of the number, what is the trend of the number, any other significant matter for the business, which is not, of course, that cannot be captured in the balance sheet, such as subsequent events. After the balance sheet date, something changed significantly for the company, or there was any big change in number for any reasons, that will go into the subsequent event. There could be related party transactions. There could be some loans with the directors of the company. There could be something else that needs to go into the notes. So this is a.
I have one question here.
Sure.
like you have mentioned subsequent event.
Mhm.
So basically, as per the standards, materiality and the prudence, like what all the income expenses related to the financial statement, if those are impacting, or what all the period it's related with that, we need to show as a respectively yearly. Like if I say, if I'm preparing a financial statement from the Jan to 31st December, and just think like till 31st December everything is fine, and in the month of Jan until I publish my financial statement, and
Mhm.
there's some big bankruptcy or some event happen, so do we require to show that also in the subsequent event? Is it a part of that, or it will not, because it not fall in my period of Jan to 31st December, but the next month something happened and it's a big change, so do we need required to show it or not?
Okay. Can I turn over the question? Okay. My
Sure.
question would be this. Okay, because this is how we need to think. You are my auditor, and I have a financial statement. If there's any, anyway. So I gave you the financial statement, which is for December 2019. Okay, I have a major manufacturing plant in the town. So the financial statement was completed as of December 2019. Everything was accurately reflected, and it was going to be signed on 30th of April by the auditors. But on 1st of April, I found out that one of the key equipment in my manufacturing unit is not working, which is either I have to maintain that and it will cost me $1 million, which will wipe out entire cash that I have. It is a significant number. Or if I don't repair this, I will lose market share by almost 25%. Right?
Okay.
Now, the question is, if I'm reporting on 30th of April, the auditors are going to sign off on 30th of April that Nidhi's manufacturing unit as of 31st of December 2019 was all going concern basis, right? Remember going concern assumptions that everything is going good and Nidhi will survive in the business, right? Second thing is that no red flag in the operations, the cash flow and everything is looking good, you know. So all the information was good. There's no impact. But this information now on 1st of April, now it is found after 31st of December, after the reporting date, right? For the balance sheet. But is this not significant? Is this not material?
This is material.
That's it. So we need to reflect that. And that is called subsequent event. It is not saying that it happened before 31st of December. It is saying subsequently to 31st December, we came to know that this has happened.
Okay.
Right.
Okay, so it will not change my uh, quantitative numbers anywhere, it's just a qualitative disclosure only in its giving.
Correct. So you're just saying, for your information, the users, please note that everything which is reflected for 31st of December is correct. However, maybe entire plant disappeared on next day. So just exaggerate that situation. So any user of the financial statement should know, right, that 31st December everything was rosy and it was accurate as well. But next day, somebody has just sold the plant, or there was a massive lawsuit. Those things typically come in the balance sheet, or sorry, in the disclosure notes in subsequent event.
Okay, one last question.
Face the lawsuit. Yeah. Go on.
I publish the financial statement. Till that report, if I got something, then it would be a part of my subsequent event. If it's affecting or changing or something like in a big, then I should report. Right?
Yeah. If it is material, and materiality is not about the number only; it is about the nature as well.
Okay. Thank you.
So this is the quick table for reviewing fair and presentation requirement, what is going concern, accrual basis of accounting, presentation consistency, materiality, offsetting, and comparative information that we discussed. What we should cover into the notes of financial statement, that we are compliant with IFRS. Also, that we are compliant with Companies Act. Also, there are other regulations that is also imposed on the company, right? If there is some FCRA or GDPR, etc., FATCA rules, various laws and regulations, if they are applicable, we need to mention that one. Plus all other things that we talked about, subsequent event, related party transactions, any fraud, any fraudulent, any checks and controls, etc. Any new vendor that you hired, that should also go into the disclosure notes. Next, third statement of financial position. So this talking about the reconciliation of the comparative period, and reporting period is important. Whenever it is longer or shorter than 1 year, we need to report as the reporting period. Here we go. I was talking about the memory map. So this for you to look into in spare time and use this to the best. Are you able to see?
Yep.
So it covers all the key points, such as a statement of financial positions, so asset, liabilities, and equity, the presentation. Then within liabilities and equity, you need to show payables, loans, provisions, and in asset, you need to show cash, receivable, inventory, property, plant, and equipment, etc. Then what do you feature in the presentation of financial statement? For the presentation and compliance, going concern, accruals, materiality and aggregation, offsetting, frequency of reporting is important, annual or less for periodic reporting, then comparatives and consistency, right? These are some of the important features for financial statement. What is the purpose? To report financial position, financial performance, cash flow, and notes. For cash flow, statement of cash flow, right? Financial position, SOCI and SOCE, right? Both report the financial position. Okay. So this is a pictorial, colorful example so that you can keep in front of you and revise it so that all the key points will remain hot in the mind. Next, IAS 8. Are we ready? We'll have some questions subsequently because it is a 43-page slide. So IAS 8.
So, Nidhi, I have one question. Like, do you have a complete statement detail as per the IFRS guideline, like income statement, balance sheet, and cash flow? I want to see the complete, like, complete detail format.
So complete detail means that will be the typical IAS 1 standard that is issued by the IAS B. Is that what you're looking for?
Yeah, means I want to see like the sales, like complete details, like sales under the sales, how many subsequent items, cost of goods sold, expenses, selling and distribution expenses, general and administrative expenses, details, all the complete format. If you have some, then could be good.
Yeah, so there cannot be any exclusive list because there could be template. I can find out and supply to you, but that will vary from industry to industry. Manufacturing IT will have a different sales, right? Any manufacturing company within IT will have a different list of sales. If you go in investment industry, it will have a different format of the P&L. So it will have varieties of different formats. But I can find out some Excel template from 1 or 2 industry, basically. So you're looking for something like this, right?
Yeah. This is basically the summary, right?
The summary. Yeah, but you're looking for something, say, 25 different line items.
Yes.
Something like this, right?
Yeah.
Yeah. So that
as
can
per the IFRS guideline.
So IFRS guideline is IAS 1 for P&L. Okay. Now all other IAS IFRS guideline will talk about the particular subject. Like say, in the next session we'll talk about IFRS 15, which replaced IAS 18. It is revenue accounting, right? So that will talk about the revenues. If revenue requires 3 line items, it will talk about this. But one complete set of the financial statement which has all 20-25 different line items, I can find out some templates online for maybe 1 or 2 industry. that could be a good example. But from, again, industry to industry, it will vary, because typically every IAS standard could be between 30 to 50 page. And section by section, that's why somewhere we have mentioned the sections, it can provide the granular and most detailed guidelines. So if you're in the IT industry or in manufacturing or medical industry, you can follow a particular guideline and your line item will change accordingly. But it may not be relevant for other industry. But there are some template I can find out.
Thank you.
Okay. So IAS 8, accounting policy. Why we need to discuss this one immediately after IAS 1 is because it is very, very related. Once we understand and we plan the financial statement to be prepared, this is the next question, that what should be the policy to be adopted? What are the estimates being made and how are we going to address the errors? So these two are normally discussed together. Selecting accounting policies. So entities needs to select the right way of or right policy, basically, just like we talked about the depreciation rules. So that rule will be selected. Second thing that company needs to be aware of is the conceptual framework of the IFRS, because the framework is kind of the master guideline for any accounting policy or the estimates. Third thing is we also need to check if there is already any particular accounting standard which dictates the accounting policy. IAS 8 is overall guidelines. It talks about how to deal with accounting policy and how to make the judgment and how to apply the policies. But if there is any specific IAS IFRS standard which talks about the particular industry practices, we need to consider that. If there is no particular standard for industry, just like we talk about now, there could be nuances and particular challenge based on industry. In IT, suppose, right? People are developing various codes. There is a race for artificial intelligence. Now there is blockchain. Many countries are still not welcoming blockchain. In India, it is still on the banned status, right? Imagine a company which has in India, which has already made a massive progress in blockchain, has done the R&D, but cannot really launch the product, right? How do we treat that? Is that asset, or do we need to write off? Or should we just wait and watch? What should be the policy to treat that expenditure? Even if the market, there is a commercial viability, market is ready to adopt, but there is no legal sanction, right? This kind of nuances can vary from one industry to another one. The question is, do we have the accounting standard for each such nuances? We might or might not. If we don't have the accounting policies or accounting standards to deal with this, what do? We apply the conceptual framework, so that we are providing true and fair view, we are providing substance over form, and we provide all the required information and disclosure so that the users of the financial statement can make right informed decision. In the absence of all the information or standards, we need to use the conceptual framework. That should be our guiding light. Or there is another last resort as well. We can use any other accounting literature, any other accounting standard from other bodies, maybe UK GAAP, US GAAP. Coincidentally, not coincidentally, actually quite factually, UK GAAP is one of the closest accounting standard which reflects IFRS. Because initially IFRS was kind of influenced heavily by the UK GAAP, right? So knowing this, you know where to look for the relevant information in case IFRS is silent on any particular topic. Changes in accounting policy. So what can change the accounting policy? There could be 2-3 situations. A, the company realized that change in the policy can reflect the transactions more accurately and fairly. Second, there will be accounting standards which will require the change in accounting policies. And in case there is any voluntary change means the company decide that there should be a change in the accounting policy, like how we treat the depreciation, or maybe how do we do the capitalization. So if we invest in certain scientific research, and how do we capitalize those expenses, the company may decide to change the accounting policy on that. In that case, it is called voluntary change. And when it is done voluntarily, the company has to retrospectively implement that change. Right? So when we are saying retrospectively implementing means, of course, the last year comparative will change, because this year, if we are making the changes, right, that's okay. But last year number, that is also likely to be impacted. So we need to change last year's number as well for similar asset or similar expenses. So accounting policy is not applied only this year, even last year. Not only that, in the opening number of the last year, right? Because if you're talking about certain assets, the asset can exist for the long time. So opening of last year, like if I am preparing the balance sheet for 2020 December, and my comparative will be December 2019. But what will be the opening number for December 2019? January 1, 2019. So I have to also amend the opening balance for January 2019. Because if I change the accounting policy, there is a likely impact on the opening number of 2019 as well. Because remember, it has to be applied retrospectively, previous years as well. So that means the opening number of the last year balance sheet will also change. And so could be for other statement, like a statement of changes in net assets. So we need to make those changes retrospectively.
Then it should be Nadish, the changing in the 2018 also, because
Effectively,
yeah.
yeah. Otherwise, January 1st, 2019 cannot be changed. So we need to apply that for 2018 numbers as well. And that disclosure has to go into the where? In the disclosure notes. We need to talk why we change the policy, accounting policy, why it will help, how it provides better view, why it is a more true and fair view, how it is useful for the investors and the users of the financial statement. We need to explain that completely. It's like standing in the courtroom and say that, okay, I made this change, this judgment, and I have the justification. Now, another thing is, if the change is required by the accounting policy, right, then you don't have to apply retrospectively. However, there's another catch. If the new accounting policy requires you to change the new accounting standard require you to change the accounting policy, but you choose to adopt that earlier. Suppose that there is an accounting standard which require you to do a certain way of capitalization, right? But that is effective 1st January 2021. But you choose to apply that from 1st January 2020, right? Then again, you have to explain why you want to do that. And you also need to explain what will be the potential impact on the number this year if you apply the new accounting policy as per the accounting standard. Because it's saying that apply from next year. You can choose to apply early adoption is permitted, but you need to explain that my capitalization or depreciation, which was X, which could be X million as per the existing policy, it could be 1.2 times of X if I apply the new accounting policy. You need to explain that one if you choose to apply earlier. Is that clear?
Yeah.
Yeah.
Excellent. The next item is in the accounting policy changes, the estimates. So the IAS 8 also deals with the changes in accounting estimates. What is the estimate?
It's depreciation policy or something like
No, the policy is already dealt with. That is accounting policy. When we talk about the estimate, it is essentially the actual dollar or rupee value, right? We talked about the depreciation, say, or amortization, right? You have a plant or you have a machinery which was being depreciated on the basis of straight line, right? You kept it as it is. You're not changing the straight line to reducing balance. However, what did you change is the useful economic life of the machine, or you change the total worth of the machine. Earlier it was 25 lakhs, now you say it is 35 lakhs. You change the dollar amount, it's going to change the depreciation per year in the straight line method. You have not changed the policy, but you have changed the dollar amount. That could be also a change, right? And you can, by changing that, you can also impact the primary statements. And remember, it is very, very useful number even for the government. You know why? Because if you change the estimates, your depreciation can change, and with depreciation, your net income profit will change, and hence the tax. IFRS requires that your taxation treatment for depreciation from tax perspective and in the financial statement should remain the same, right? If the two remain same, then your change in the estimate is going to impact the treasury, the government's tax collection as well. So that is a particularly important number. So anyway, change in accounting estimate is about the number of years or the dollar value. When you are going to change those quantity, it is a change in estimates. Now, that is considered as an error if you are changing this year. Hence, those errors needs to be rectified for the prior years, right? Rule of thumb, always remember frameworks. Rule of thumb says that IFRS statements needs to have comparative. You need to have the previous year number. If you change any number here or estimate this year, very likely it's not going to be consistent with last year's number. So you need to make those corrections for last year as well. So any change, such change should be done very carefully and with concrete logic. Because not only you have to make the changes this year, you have to make the changes for prior periods, and you have to explain the disclosure notes, why did you do that and how it benefits the users and how it is more true and fair.
this one thing like by changing this thing, if any liability will be arised, say tax liability or something,
Yeah.
so if we need to pay it also, then do we implement like apply the penalty or something, or it's just like a disclosure like as I identified this time, and by changing the policy I get to know like it's increasing in the liability, so that I need to pay it. So
No
there would
penalty.
not be any penalty on that.
No penalty. It is considered that you have done in the good faith. As long as you make the changes consistently, you provide the explanations, and you incur any liability, you pay it on time, just like any other liability, there's no penalty.
Okay.
That is at least based on majority of the international taxation, India, Ireland, UK, US. So based on three, four countries tax rules, I can say maybe some exceptional country have different rule, that's a different thing, but generally it is not. Okay. All right, so in the absence of a standard, it is saying that what are the rule of thumbs for IAS 8. So if there is no accounting standard to guide on the accounting policy for a particular industry, you need to apply the framework. If there's no framework, or maybe if the framework is also hard to apply or does not provide the required guidance, then you can also consider other accounting pronouncement or the standards from similar bodies that we have discussed. So there are like 2-3 options that you can use effectively. Particular IFRS or framework, or lastly, other accounting bodies standards like UK GAAP, US GAAP, etc. Consistency. We have talked about this as a framework in IAS 1. Consistency is the key. Accounting policy cannot drastically change. Let's take an example. Actually, it cannot change. Not only drastically, it cannot change. Okay, let's take an example. We are depreciating one machinery on the straight line basis, another one on reducing balance. Because reducing balance, remember that that triggers higher amount of depreciation per year as compared to straight line. Companies might be tempted to use different policies for similar assets. That is not permitted because it is not consistent. Consistency is also key, right? Because somewhere inconsistency means there is a lack of, true and fair reporting. Something is being hidden, or the numbers are being manipulated to, wash out some anomaly in the financial statement. That's also called window dressing, right? And those window dressings are addressed when there is any financial or economic disaster, like a typical bloodbath situation. Many companies will try to show a massive loss for year end 2020. Any good forensic accountant or auditor will be extremely careful next first quarter of 2021. This is going to be a very, very cautious period for them, because many companies who had been kind of adopting kind of malpractices or not providing to a fair view, they will try to do the bloodbath accounting this year, because everything is bad, the business is wrong, and businesses are not doing good. So all the provisions of bad debt will be implemented now. All the massive amortization or depreciation will be effectively done this year. Because typically there is an excuse saying that, okay, the COVID was there, that's why business made the loss. But under that, there could be loads of other accounting gimmicks can also be polished. So there should be a consistency in accounting policy. Do you remember the stories of Enron, Parmalat, Satyam? The accounting anomaly was done for years and years, but sometimes the management can wait for bad years in the business, because at that point of time you can adjust all the accounting malpractices, because one day it has to be exposed. So that is the best year to kind of settle all the accounting issues, because everybody will understand that the year was bad, and no one will you really get panicked if the numbers are extremely bad. But all other years can be shown rosy and golden. So that's called window dressing accounting. Third, an entity is permitted to change accounting policy, of course, if it is required by the rules or the standards, or it provides a better, reliable, more true and fair view. Now, all these changes in accounting estimate also needs to be applied prospectively too. So prospectively means all the future numbers to be affected. To the extent that a change in accounting estimate gives rise to changes in asset and liability, it is recognized by adjusting the carrying amount of related assets, liability, or equity item in the period of change. It is essentially saying that if any change in accounting estimate, remember, for a machine, the dollar value of the purchase or the cost or the useful economic life, if that change, and I think it is quite likely, changes the asset or liability, which also impact the equity, then the carrying amount of that asset also need to change. Let me translate in a simpler word. I talked about a machinery, and we change the useful economic life from 10 years to 15 years. What will happen? The depreciation will go down for that year. Also, the opening value of that asset, that will also be impacted, right? And that opening value will go up. Do you agree? If I increase the number of year for the accounting estimate, sorry, if I increase the number of year of the useful life, the opening carrying amount of the asset will be higher, right?
Yeah.
Okay. Or if I reduce the useful economic life, the opening value will be lower, right? If I reduce the economic life, then it will be lower worth of asset and an expense in the P&L, right? That expense of the P&L will hit the profit and loss and other comprehensive income. Okay. So, and where it will go? That particular change I'm talking about, when I change the useful economic life or I change the economic or accounting policy, it is going to have a hit on the P&L, right? But we need to be careful. That hit on the P&L is not like all other P&L and expenses. It is not. It requires us to stay alert. Do you know why? Let's recall our discussion from IAS 1. We talked about this in IAS 1 that any impact of the accounting policy or changes in accounting estimates on the P&L is also going to be reported under statement of changes in equity as one of the line item, because it's not an ordinary expense. It is a very special one. Why? Because if this being highlighted in the statement of change in the net equity, which is one of the primary statement, if we are reflecting that on the face of the primary statement, also we need to explain that in the disclosure notes. It will kind of give the message to the management that you cannot change such estimate frequently, right? It is not like any other expense. Otherwise, it can be changed year on year, and it will be easy to manipulate the balance sheet and P&L, isn't it? Hence, the rule that you need to reflect it on the face of the statement of changes in net assets and also in the disclosure notes, so that management has to be very cautious while making such judgments and the changes. Somebody is saying something?
Sorry, Nidesh.
Yeah.
I was not on mute, but
Okay.
to be honest, I'm a bit confused now between change in accounting principle, change in accounting policy, and change in accounting estimate.
Okay.
So we are saying change in accounting estimate should not impact your prior year's statements, right? If let's say if there is a change in useful life of the assets, or there's a change in depreciation method, that should be reported prospectively in your P&L and maybe current year financial statement. And if it is impact your future statements, then the treatment should be prospectively instead of retrospective, right? In change in accounting estimate. I'm a bit confused between both now.
Okay. Let me clarify. So when we are changing accounting policy, we make the changes retrospectively. Okay. So I think that's the core area of the confusion. In case of accounting policy, we make the changes retrospectively for at least 2-3 years, straight from 2018-20. Also, we need to reflect that in the disclosure notes why we made the changes. However, in case of accounting estimate, we make the changes retrospectively because because number of years in the future will impact, right? So we make the changes prospectively, because it will reflect the future estimates. A. B. There is a significant impact on the carrying value of the asset, right? Carrying value.
Yes.
So if you make a change in estimate, like say machine was estimated to be 10 years useful life, now it is 15 years useful life. That would mean that your carrying value is going to change. So if you change the carrying value, then your total worth of asset is going to move, right? Going to change. that would mean that there is an unrealized P&L, isn't it? Because whenever your carrying value changes, there is an unrealized P&L, right? Created. You agree?
Yeah.
So that unrealized value, because ab kya hoga, if machine was worth useful life for 10 years, now it is 15 years. Any machine which was say 10 lakhs, now it will go little up in the value. Now that unrealized P&L will be positive in your P&L statement of profit and loss. We need to reflect that also in the statement of changes in equity, right? Here we don't have to apply that in the past previous statements. And you know why? Because we are directly making the change in carrying value. Because if we are making the change directly in the carrying value, the impact of this change in estimate is taken care of at the start of this year. And any P&L which is generated, plus or minus, that will be also reflected in the statement of changes in net assets, right? And that P&L will be reflected in the profit and loss and other income, comprehensive income, as a other comprehensive income, not as profit and loss, right? You agree? Because it will go in multiple places. A, carrying value will change. Great news. That means you have a P&L, okay? But where in the P&L it should be reported? Now you have to make the call. It should not be reported as a normal P&L. It is not a normal P&L. It should go into the other comprehensive income, right? Because it is unusual P&L. Very good. Now if it goes to other comprehensive income, it also has to go to statement of changes in net equity, net assets, right? Why? Because generally whenever you report something, now remember another rule of thumb. Generally, whenever you report something in other comprehensive income, you must also report that number in SCNA. I am tired of speaking that long word. Statement of changes in net assets. Okay. So that also goes there. And you're reporting all the change in accounting estimate prospectively. But in case of accounting policy, you are reporting retrospectively as well, right? Of course, there is one exception for accounting policies retrospective changes. What is that exception? If the accounting
practical
standard, if that new accounting standard requires you to do that, then your multi-year backward recalculation is not required. Understand? Agree?
Yeah. Yes, there's one more thing, right? In policies, accounting policies, that if it is impractical to assess the impact, then you may just choose to put something in disclosure, something like that. I read somewhere in your slide.
Yeah. Right. So it is saying that essentially, if you cannot make a reliable estimate of how it will impact in the future prospectively, then you can just make that note in the disclosure note. In that sense, remember, IFRS is so flexible as well, isn't it? It's not forcing you to always make the quantification. Once we talk about IAS 7, when we'll talk about the cash flow, we'll see some more example that you have so much flexibility to report the number under various categories. Now, this is another situation. If it is impractical to estimate, you can make a note that it cannot be reliably estimated. Because if you just throw a number, then somebody will ask that where it is coming from. So it's better make a disclosure. Okay. Are we good now?
Yeah, Nidesh.
Yeah.
Great.
Thanks.
Okay. So the general principle in IAS 8 is entity must correct all material prior period error retrospectively. by restating the comparative amount for the prior periods presented in which the error occurred. So there we agree. On the point A, I think we agree that we are going to make the changes in the prior period. Of course, the idea here is that when it is not forced by the accounting standard, then of course we have exemptions. Now, second point is little complex. If the error occurred before the earliest prior period presented, restating the opening balance of assets, liability, and equity for the earliest prior period presented. Okay, in simple language, it is saying, you remember the example of 2020, 19, and 18, right? So imagine when in some situation, even auditors require you to have 3 years reported on the balance sheet. Okay. But even if you say you are reporting 3 years and accounting policy that you have changed, it can impact the numbers for last 5 years. What will you do? You cannot report all the 5 years. What you need to do is take the earliest year that you have reported. Say in this case, you are reporting for 2018, 2019, 2020, 3 years. You need to take the earliest year, 2018, and then choose the earliest date, 1st January. So you make the restatement of all the numbers, and all the numbers means change in the balance sheet, asset and liability both. Statement of changes in net assets needs to also change. So change all the numbers because of the change in accounting policy for the earliest periods, earliest date, and re-prepare the entire financial statement from that date until now. Restate, literally restate everything. Because whenever you see the word restate, it means you have to revisit every single number for the accuracy. Because generally this will impact your balance sheet number, very likely asset or liability, and then the P&L, and also the cash flow. Your, of course, net cash flow will not change, but line items might change in the cash flow, individual line items. Most of the cases, it becomes a netting of difference in the line items of cash flow, but still you need to make those changes. Then your disclosure notes will change in various places. Are we good with the point number 5?
Yeah, Nidish, just to clarify, like you have mentioned that if in case of there's a 5-year changes and we need to show the statement of the 3 years only, then the 2 years, okay, the 2 years, what is my impacted? Like say the P&L, if I impacted a $1,000, so it would be a part of my comprehensive income, what you have mentioned. So do we need to show any kind of a working in the disclosure or something?
Yes, you need to prepare a little. So you're right. You need to impact the number from 2018, 19, and 20. A. B. All the P&L that is generated because of this adjustment, you need to hit that P&L this year only, not in 2018 or 19. It will be hitting this year only because we have made the change in accounting policy this year. Second thing, third thing, how we disclose. We need to put a paragraph in the disclosure notes. And generally there is a paragraph for changes in accounting policy in the financial statement. You need to talk about that. Okay, you have the management has decided to change the policy, blah, 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 and then make the calculation saying that, okay, as per the previous method, it was X million. Now, as per the new method, it is Y million. Here's the delta. And this is how we have made the adjustment everywhere. So you have to make a detailed calculation and the table and put into the financial statements disclosure notes.
Okay, thanks.
Welcome. Changes in accounting policy. So it's a summary. So a change in accounting policy may be necessary to enhance the relevance and reliability of information. Again, matter of voluntary change. The management may believe that henceforth the change in accounting policy is required in the interest of accuracy. Such changes are voluntary, and this needs to apply retrospectively, as we discussed here. Apply retrospectively in the financial statement. Now, retrospectively means as if it was always there. So as we discussed, if it is impacting 5 years, we have to consider that it started 5 years ago, the accounting policy changes. We will not consider that, okay, we are deciding this year, so let's only report for 3 years. No, it will start from the day one the machine was purchased, and you need to apply all the way until that date when the machine was purchased, and then you need to apply that change in accounting policy from that day until now, which we have discussed. Consequently, entities shall adjust all comparative numbers presented in the financial statement. Yes, for all last 2-3 years, we need to, of course, restate the entire set of financial statement, not 1 or 2, entire set. That means including disclosure notes. We need to change everything. Massive work, isn't it?
Yeah.
So now imagine so many accounting standards and so many different regulations coming up every year, how much additional effort goes, it increases the cost, and ultimately those costs are passed into the investors. Hence, the harmonization and convergence of the accounting standards are needed, and importance of IFRS is going up and up. Exemption, there is some exemption as well. Good news from the retrospective application of accounting policies, right? You will like this section A to G. Retrospective application of a change in accounting policy may be exempted in the following circumstances. If the change is required by new IFRS, we have talked about. The application of new accounting policy is again so much different in terms of transactions, even in circumstances, so that new accounting policy also might change your concept of estimate, how you need to estimate the useful life or transactions. That can also be changed because of the new accounting policy. So again, you are exempted. If the impact is immaterial, then you are excused. If it is impractical, again you are excused. Okay, but you need to provide the complete disclosure. And if it is not practical to do that, you need to provide the full detail, and maybe you can also refer certain examples from the industry. So you can use those clauses where relevant. What are the disclosures for the financial statement in relation to accounting period? So title of IFRS. Why we are talking about the title of IFRS? If there is any change in accounting policy driven by the accounting standard or IFRS or IAS, you need to mention that detail, like title of IFRS, what change is propounded or required by the accounting policy, and why this change you have decided to take. It's not necessary that every time accounting standard require you to make the change, and it is not necessary that you have to make the changes. That's another thing, remember, because you can choose not to make those changes despite the fact that the policy is there. Yes, maybe 90%, 95% cases you are required to make the changes, but still you may choose not to implement the changes. And if you choose not to implement, you need to provide a full explanation why you have done so, because you are still you have still rights to not implement those policies so long as you explain this. So it's like comply or explain. It's not that, okay, comply only. And of course, then you need to provide all the quantitative disclosures, like number of, say, depreciation methods, or maybe capitalization methodologies, or how much you have capitalized and what is the worth of the asset, and how the new policy will impact the depreciation versus how much it was in the past, and what is the total carrying value. All these details you need to provide in the disclosure notes in the tabular manner. So that's what it is saying. What will be the disclosures under IAS 8. Now here comes another table, memory map. It just summarizes the entire concept in a pictorial way. Okay, you can check that and have fun with those colorful depiction. Now some time for question and answer. Is there a true and fair override in IAS? So true and fair override means that says, can true and fair principle override the requirement of IAS or IFRS standard? Okay. The other one, so answer is yes. Another good question I had actually, I will add the question here, that IAS 1 also provides that liability can be classified as current, okay, if one of the following criteria are met. So sometimes there is a question that what if a liability is to be settled after 4 months? Or what if the liability is going to be settled anywhere between the current operating cycle? How do we treat that? The answer is that it is a current liability. If it is going to be settled within 12 months or within the current operating cycle, if that liability is coming from the trading or the regular operating activities. So just an important section that I have provided here. Which national standards are closest to the IASB? I have mentioned earlier, UK GAAP.
UK.
Yeah. In fact, when I was doing the graduation, that time we were studying UK GAAP because of course it was a British university, and all the substance over form, FRS 5, 25, 26, and all those standards that I studied. And when I started to study for ACCA and IFRS, it was kind of very, very similar. And I was thinking that why those have so much similarity. Later on, I came to know that UK GAAP is very, very close to IFRS. Is it necessary to adhere to all the requirements of IFRS for financial statements to state compliance? Yes. Answer is yes. We need to adhere to all the requirements of IFRS in order to say it is compliant to IFRS. No exemptions. Fourth.
But if there is no specific IFRS, and then we borrow something from other GAAP or standards, right?
Mm-hmm.
So then in that case, it could be no, right?
It is still yes. You know why? What is the statement? All the requirements of IFRS, it is saying, right? Say there is no IFRS to say deal with, say, space mining, right? There is now another industry coming up. Some countries are trying to mine the gold or other precious metals from the space, but there's no IFRS for that. You might try to apply other accounting standard or maybe the conceptual framework itself, or apply your own judgment to provide true and fair view, right? That means you have done all the best effort possible. You have utilized all the information from the IFRS standard, right, to adhere. You have not breached any. You have not disobeyed any IFRS requirement. Actually, you have tried to implement this, but you could not find one, isn't it? That also means that you have adhered to all requirements of IFRS, right? That's the statement here.
Okay.
Because it is just that the IFRS is falling short of the requirements or the need, but you have not breached anything. So answer it will still be yes. Then there are rare earth metals. There are so many new industry popping up, and the accounting standards are still not there. Should the going concern convention be dropped when a part of the reporting entity is suffering financial difficulty? Again, materiality. And that's why I highlighted materiality is a very good concept. So it is saying essentially that if one part of the entity is suffering financial difficulty, but as an auditor, you are concerned if it should still be going concern or breakup basis. How would you decide? Answer is judgment, materiality, your experience. And what do you think will be true and fair view? That is the answer. No other rule of thumb. If that operations or financial difficulty can impact the overall organization or cash flow, or can impact the entire market, something very critical, then prepare the financial statement on breakup basis. Is that clear? Okay.
Yes, Nidesh.
Is consistency of accounting policies from year to year required? Answer is
Yes.
Yes.
bold, underlined, yes, yes. So, can a loan which is due to be paid back in 4 months be a non-current liability? Oh,
No.
answer is already given, yeah, earlier. No. As expressed in IAS 1, what is the overriding principle that should be followed in preparing IFRS based financial statement? What is the overriding principle? The overriding principle is that
IAS 8.
no, it's saying that, okay, referring to IAS 1, what is the supreme principle? What is the constitutional, like what is the fundamental rights of accounting system? What is one rule that can override all the principles? And that is true and fair view. Relevant and the best possible information. If no information is there, overriding principle is that true and fair view should always prevail. Eighth, what is the IASB principle based approach to accounting standard setting? So it's saying that principle based approach. What is the IASB's principle based approach to accounting standard setting? Now here it is saying it should be substance over form. So what it's saying that whenever the IASB, suppose that you are sitting in IASB board, right? And you're drafting the financial standards. What will be the one thing that you think that, oh, if I follow that one principle, everything will be right? Okay, so that's a simplified version of this question in a simple word. What is the principle based approach to accounting standard setting? So if you're setting up the accounting standard, a new accounting standard, what will be the principle based approach? So the principle based approach should be substance over form, because in all the standard, that is one aspect that you'll see, one common pattern. We talked about, right, accounting policies right now. We talked about the how to report in the P&L, and also the hedging earlier, IAS 39, etc. In all these aspects, you will see either it is talking about the true and fair view or substance over form, which are the same thing. It is saying that reality is the supreme idea. Reality of transaction is more important than completing the rules. And in all the principles, accounting standards, the regulators are asking for the substance, the reality of the economic transactions. What would be the advantages of having a single set of accounting standards used worldwide? We have talked about this: low cost, speedier process,
Comparable.
efficiency, comparability, better investment, competitiveness across the world, raft of benefits, saving of time and efforts. Here comes an interesting question. Question 1, during the year to 30th September 2008, you want to attempt or should I go ahead?
I think we will.
Sorry?
I think we will do the later.
Okay. Yeah, this is a good question, by the way. So you want to attempt other question? Shall we go through this?
Yeah, Nidish. So we can do like a numerical, might be when you circulate the PPT, we can try it by ourselves, and in case of any
Great.
question, we'll come back. Yeah.
Makes sense. So which of the following does not have to be included in the statement of change in equity? So SCNA, right? Typically that you all prefer to say, right? SCNA. So what is not included in that?
Third one.
C, right?
Each item of the comparison.
Yeah, that does not go there.
Yeah.
Excellent. Which item must be shown separately on the face of SOFAP, the balance sheet? Which does not
Everything.
appear? Which item must be shown
Everything.
separately?
All of the above. It's not there.
Actually, look at the word. It's saying must be shown separately.
Yeah, then A. I think it's A.
Check.
Repayments.
Dance dekho.
Separately on the face of SOFP financial positions. Tax liability.
Yeah. Assets, intangible assets.
No tax liability.
Tax. If you omit tax, that will be regulatory breach as well. Because intangible asset, it may or may not be there, right? You don't have to show. You might not have intangible assets. Work in progress. If you're an investment company, there's nothing work in progress. Financial companies. Prepayment. If you're running short of money, you are not prepaying anything, maybe it's not there, or maybe a very small amount. If it's too small amount, immaterial, you don't have to show. Tax liability, even if it is $50, you have to show.
Always be there.
Yeah. Balances under the following headings are extracted from the books of EVO, a limited liability company. So it's saying accountant wishes to use a format 2 type of expenditure. Do you remember what is format 2 type of expenditure?
Nature and function.
Yes.
Function wise. Yeah.
Functions. So it's saying which of the above balance may be included without further analysis on the face of a statement of profit or loss and other comprehensive income. Like 1, 2, 3, 3 expenses are there. How those 3 expenses should be reported? If you choose to report as function, you choose the function as that expense type. Which one should go for sure?
Change in inventory. A and 3. Not sure.
I think D.
It's a B.
Yeah. Consulting is a very obvious one. And changes in inventory. Financial statements provide info about an undertaking. So we're saying that, okay, asset, liability, equity, income, expenses, other changes in equity, cash flows, employment policy. There are 7 different type of information that you're looking for. So what do you typically get in financial statement out of those 7 pieces of information? Simply, you get everything but employment policies. That's the only thing that you don't get in financial statements. So all 7, no, not all 7. This one, 1, 2, 3, 4, 5, and 6 are correct only. A.
1, 2, 3, 4.
Just leave 7. A complete set of financial statement comprises what? 1, 2, 3, 4, 5, 6.
Statement of
B.
except 5th.
2, 3, 4.
Yeah,
6,
it should be B.
Yeah, B.
not all. Director's report.
B.
Oh, it should be all.
No.
Sorry, it should be all because director reports also we are showing. Sorry.
Director's report are essential part of the financial statement as well.
Okay.
So generally, when we call notes, that also is comprised of. In US financial statement, it is called management development and report, something like that. The directors talk about the overall business and how much confidence they have in the business. Take that with a pinch of salt if you are auditor.
What was the answers, Nidesh? I think your voice is breaking. Your
All.
voice is breaking up.
Oh,
All.
1 to 6, all inclusive. Option C. Option C.
Okay.
Okay. Environmental report and value-added statements are provided within financial statement or outside IFRS. They are not. Never provided with financial statement. It's not outside the scope of IFRS, but not provided with the financial statement.
It should be one,
knowledge,
right?
Sorry?
It should be the first. The answer is the first one, right?
First, yeah, never provided with financial statement. But I'm saying it is not outside the scope of IFRS. It is not.
Okay.
But there is no separate report given.
Yeah.
Users' knowledge of business and accounting is assumed to be reasonable, negligible, comprehensive. When we are talking about users, it could be any rich investor, or it could be a scientist or government bureaucrat.
I think A.
Correct. Reasonable. An entity prepares its financial statement that contains an explicit and unreserved statement of compliance with IAS. So it is essentially saying a company prepares the financial statement confirming that they have complied fully with IAS or maybe IFRS. The auditor's report find out that there are some disagreement, there is some breach of IFRS in the financial statement. Now it is asking, in such case, is it acceptable for the entity to make an explicit and unreserved statement of compliance with IAS? Even if one paragraph is missing or you have not complied with IFRS, even if you miss to comply with one IFRS, it means you have not complied with IFRS. Answer is false. A company entity cannot claim to have complied with the IFRS if it has missed to comply with any single IAS or IFRS. Okay? You have to comply with all IFRS, all IAS. Of course, something not relevant to you, ignore. If you're looking for something and it's not in IFRS, it's okay. Take the best judgment. But if something is written in IFRS and you're not complying with that, you're not in compliance. You are in breach. It's such a good standard anyway. It's so flexible, reasonable. Why someone will choose not to comply? I just like IFRS. An entity cannot claim compliance with IAS if it has not complied with one or more IAS with financial statement. It's a very similar question. Again, answer is, except for compliance with one or more standard, answer is again false. It has not complied fully. Are you reading?
Yeah.
Just 3 more questions.
It should be A.
Yes. Are you all happy? So para 10A of IS1 requires you to provide statement of changes in equity as part of balance sheet. Which of the following items are required to be disclosed in a LLC's financial statement? According to IAS 1, presentation of FS.
I think all 4 items.
All 4.
Correct. Finance cost goes into the cash flow. Authorized share capital and issue
Change in
share
equity.
capital will be definitely in SCNA. Depreciation and amortization in the P&L. Next, which of the following could appear as a separate item in the SCNA required by IAS 1? Presentation of financial statement as part of company's financial statement. Okay. Which should appear as a separate item in SCNA? Simply, that's a question. And it is multiple, like more than one answer. Gain on revaluation of land. Help me analyze this item. It is not ordinary business. It is extraordinary. It is a new, like a non-recurring. Yes. Loss on sale of investments.
No.
No.
Okay. Prior year adjustments.
Yes.
Okay.
Yes.
Okay. Proceeds of an issue of ordinary shares.
No.
Yes.
Yes. Dividends proposed after the year end.
No.
Right. So how many years? 1,
3, 4.
3,
First one.
and 4. Yes.
4.
Yeah. A. First option.
But dividend distribution, generally we show it in our SOCINA, right?
Correct.
Dividend distribution.
We are asking for that only, Jagresh. We are asking that only. SOCINA, what is the separate item we are showing? So dividend and all kind of a distribution and the shares issuance we are showing separately.
After the year end, we don't show that.
Yeah, year end we are not showing.
So that's the catch.
Okay.
Normally objective can be sometimes very, very apparent, but 1 or 2 words can just be there to make the answer wrong.
So Nitish here, means instead of the year end, we can see here that this is the dividend proposed. So basically we are not proposed any amount proposed related to the proposed, we are not showing in the SOCINA, right?
Yeah, because statement of changes in data sets that could go in the disclosure notes.
Okay.
But we have talked about the reconciliation of the SCNA, statement of changes, right? When it comes to the capital, we can have a complicated situation whereby you have 2-3 different types of capital. So you need to start and end and provide the changes. So opening, changes, and end for all 3 types of capitals. That's the most complex situation generally. Then all the adjustments, P&L for the year, opening, all those things will go. But generally, how much dividends are given, that's not the subject matter of SCNA. Because SCNA is kind of very typical to a balance sheet. It tries to match your balance sheet net position. And balance sheet never bothers about, showing that as line items. It could be after the line item. It could be after the net assets, right? Dividends proposed or dividend to be given. But when you look into the assets equal to liability plus equity or capital, how much dividend is proposed to be given, that does not come in picture anyway, because your asset and liability, all these things will balance without that number. Is that what you're asking for?
Yes.
Right. So SCNA to me, I have always seen that like a additional note for the balance sheet. It just reflect whatever is in the balance sheet. It reflects, it just reconcile that, okay, when we open the book, it was this much. When we close the book, it is this much. And here's the delta for the year. And then it matches with the balance sheet. Generally, dividend numbers are reflected in the cash flow from financing in cash flow statement across all the industry almost. Of course, IAS 7 gives some flexibility in that for that as well. We'll see when we'll go into that standard. It let you decide between cash flow from
in our fund industry.
Yes.
But in our fund industry, generally dividend distribution during the year, we disclose it as a separate line item in our SOCINA.
You're right.
Because the dividends of the fund industry is not the actual dividend that is relevant for manufacturing industry, right? The dividends which is given in the fund industry is more for the investment related related products.
Yes.
So then it becomes kind of an operation related.
Out of
it's operations business.
Right. Yeah, for fund industry, correct.
Okay. And hence the beauty is, and that's why you'll see that in the fund or investment industry, there is no cash flow from investment. Generally, there could be hardly one or two line items. Why? Because investment industry do not do any investment, because all the investment is operations.
Right.
Yeah.
Everything it invests into is its hardcore operations, and its investment is nothing. You know, so it's just like, you know, if there is a professor and professor buys the book, it is like their business, not their investment. So that's why industry to industry, all these things changes, and the cash flow statement becomes completely different in the format for the fund industry. And of course, dividend and all these things have a different look, quite often confusing as well for those who are used to a different format of the financial statement. Anyway, great. Any question overall before we close?
We are good, Nidish, I think.
Excellent. So I'll send the PPT shortly. All right. And see you later on Saturday.
Thanks.
Thanks.
I got the online book. I think you have already enrolled, right?
Yes, but online books